For decades, there has been an argument between two schools of thought. One is active investing, which is buying and selling individual stocks. The second is passive investing, which is following an index like the S&P 500. Active investors will buy or sell individual stocks or pay a fund manager to do it for them. Passive investors will buy an index fund, typically done through either an indexed mutual fund or an exchange-traded fund or ETF. Both of them have their distinct pros and cons, but in today's video, I want to show you what I believe is the third option, and that is to create your own index fund. So rather than buying a pre-made index fund, you simply make your own. In this video, I'm going to show you how to do that. Before we get started, I want to remind you that this video is for educational purposes only. It is not investment advice. It is not an offer or solicitation to buy or sell any security. Investing involves risk. You can lose money. Do your own research and consult a licensed professional before acting. I may hold positions in companies discussed today. Positions may change without notice. Opinions are my own. Data are believed reliable but not guaranteed. See the video description for the full disclosure. Let's start with a clear definition of what we mean by active and passive investing. So in an active investing scenario, you have a fund manager. This could be you. It could be someone that maybe works for JP Morgan or BlackRock or some other fund. And either you or the fund manager that you're paying are deciding in their minds or in a group or whatever, whether they should buy certain stocks. So they may say, let's buy, Microsoft, let's buy NVIDIA. And they would do that by starting with some kind of investing philosophy. And then they would get on their computers and do research, look at financial statements, maybe read the 10K, do some sort of valuation models. Whatever it is that they do, they may be taking some combination of data and subjective analysis and combining it to decide which stock should go in the portfolio and what weight. In a passive investing scenario, what you have is the index creator. So typically this would be someone like MSCI, or the S&P 500 is maintained by Standard and Poor's. So they would have a committee, typically, of people who are responsible for basically defining either the rules or picking which stocks would go in a particular index. So in most cases, what these people are doing is not necessarily deciding which stocks should go into the portfolio. What they're doing is defining the rules. So they're saying that we only want to own US stocks. That might be one rule. We also want them to have a minimum of, say, 4 quarters of profitability. And they'll also define weightings. So for example, the S&P 500 is a market cap weighted index. So they'll define what that is, what that means. And then once these rules are in place, the rules actually go and select the stocks. So if Microsoft fits all of their criteria, or ranking system, or whatever it is that are defined in these index methodologies, as they call them, those get added to the index. So in the S&P 500, for example, you'd have market cap weighted. So NVIDIA would end up being about 7% of the portfolio, Microsoft about 7%, Apple at 7%, and so on and so forth. But you can't actually invest in an index. So what happens is there's an intermediary. So an intermediary like Vanguard or BlackRock or whoever it is, State Street, they will sponsor either an ETF or a mutual fund, an indexed mutual fund. So rather than picking which stocks go in the fund, Vanguard or BlackRock are just subscribing to the index. So they're paying MSCI or Standard & Poor's some level of fees, minimum level of fees, and then they are just copying the index essentially. So you're investing in a Vanguard or BlackRock ETF or fund that's following an index of some kind. The third option, I believe, is somewhere in the middle of these two options that combines the strengths of passive index investing with the strengths of active stock picking. Both of these methodologies have their advantages. Active strategies have the benefit of 100% customization. So you can decide exactly what kind of characteristics you want for your portfolio and follow those to a T. The other benefit of active investing is that typically you have a little bit more downside protection as you've got somebody that's paying attention and watching out for potential downside risks in the economy or whatever. So some research suggests active portfolios can manage risk better than passive portfolios. And the third is the potential to outperform. And we say potential because most active funds fail to do that. In fact, 90% of active mutual funds will end up underperforming their benchmarks. And the main reason for this is that these very smart people here are paid a lot of money. So you end up having to pay their salaries, etc., and pay fees to both cover them and the profitability of the companies. So BlackRock's not running a charity. They're paying these fund managers to buy and sell stocks. And then above and beyond that, they want to earn a profit, so they're going to charge fees commensurate with that. Another negative with active funds is that you have turnover, and turnover leads to both transaction costs as well as taxes. All of those things eat into your after-tax profits. Now, the other form of active investing is stock picking. So obviously, if you're the one picking the stocks, you don't have to pay yourself, so you actually end up paying zero in fees. The problem with stock picking, and the reason most people suggest most people don't do it, is because there's quite a bit of additional risk. And the main risk with stock picking is that you probably aren't very good at it. So people that don't know what they're doing end up trying to pick stocks, and they end up having terrible performance that really hurts their long-term wealth accumulation. Proponents of passive investing say that rather than paying these people to manage the portfolio for you, what you should do instead is buy a low-cost index fund. So the index fund is not paying anyone to buy and sell and make decisions. They're just following this index. So it ends up saving you quite a bit of fees, and lower fees tend to increase overall performance because you end up having lower cost, both from lower fees and lower turnover and lower taxes. The main drawback with a passive fund is that these particular rules are not necessarily designed for you, so you lack and lose a lot of customization. Of course, there are a bunch of different indexes out there, so you could try to find one that fits your particular needs, or you could do this instead. Simply create your own. So when we create your own index, what we do is we simply replace the people making the decisions on what the index should look like. We eliminate MSCI and Standard & Poor's from the equation, and we put you in the position of the index creator. So you're going to decide what exactly is important to you. What kind of rules and processes do you want to follow in determining your portfolio? And then you will execute this plan by actually purchasing the individual stocks that meet your particular index. So that also eliminates the need for Vanguard and BlackRock and ETFs, and just puts you in the position to buy these stocks individually. And since you buy these stocks individually, you actually eliminate fees entirely. So there are no ongoing management fees that you have to pay. And also, depending on how you set it up, you may not pay any taxes because you don't necessarily have to buy or sell any of these stocks. We'll talk about that more in a little bit, but if you have no turnover, you have no transaction costs, and you have no taxes. You also have the benefit of full customization, so you get to decide exactly how you want your portfolio to look and the kinds of things that are most important to you. You also have the potential to outperform the S&P 500 or whatever other benchmark you want to follow. And if you'll notice, all of these are the exact same strengths as picking individual stocks. The key distinction between creating your own index and stock picking is that you dramatically reduce the risk. The biggest risk with picking stocks is that you don't really know what you're doing, and there's also a major behavioral element to it. So if you buy a stock at $200 a share and that stock drops to $150 a share, a lot of people panic and sell the stock. Or if the stock goes from 200 to 300, people will sell it and take a profit, incurring taxes and transaction costs along the way. This litany of potential behavioral errors cause most people who pick individual stocks to perform pretty terribly. So if having to choose between picking stocks or buying an index, most people will do better buying an index. But when you create your own index, Assuming you have the discipline to follow through with that consistently over time, you can substantially reduce that risk. So how are we going to actually make our own index? Well, before we do that, let's look at what an existing index has within it. So what are the components of an index, and then we'll take that and replicate it for our own use. So all indexes basically have these same three things. And we're going to look at those one by one. We're going to use an actual example of a real index that is actually quite popular because it's the index behind the ETF SCHD, which is a widely followed dividend ETF. So we've got the smart people at Standard & Poor's that are doing this index for us. So let's take a look at what they include in this document. So first, all indices typically will have a universe. So in this case, their universe is defined as the constituents of the Dow Jones US Broad Market Index, excluding REITs. So this is a broad index that probably has, let's say, 3,500 stocks in it. And then they're going to exclude REITs, so maybe that takes us down to, call it 3,250 stocks. I'm just guessing. And then they're going to further screen these for different liquidity. So they require a minimum of $500 million market cap. They need 3-month average trading volume of $2 million. Both of these aren't as necessary for you or me since we're not that big of investors. We don't have these same liquidity constraints. But in this case, they also screen for a minimum of 10 consecutive years of dividend payments. So let's say out of this 3,250 stock universe, after they screen for everything, maybe they end up with, let's say 1,000 stocks. And then from there, what they do is take all of those stocks and they rank them in descending order by indicated annual dividend yield. And they tell you how that's calculated, and then they take the top half of those. So if there was 1,000 stocks, that would leave them with 500. So after all that, they end up with their investable universe. And then they move on to step 2, which is index construction. So they're going to start with their 500 stocks that they pass through the universe, and they're going to rank them by each of these 4 fundamental base characteristics. The first is free cash flow divided by total debt. And if the company has 0 debt, they get ranked first. Next, they use return on equity, which is the trailing 12-month earnings per share divided by the company's latest book value per share. Anything with a negative book value or negative earnings is ranked last. They also rank by dividend yield. And then finally, 5-year dividend growth rate, and they give you the formula here. And then they take all 4 of those rankings and sum them to create a composite score. So the stock with the best overall score here would get a 1, then a 2, then a 3, 4, 5, etc., etc. And then they're going to take the 100 top-ranked stocks by the composite score and add that to the index. Finally, there's a section on weightings. Most indices are going to be weighted market cap. So the S&P 500, for example, is weighted market cap, meaning the bigger a company gets, the bigger the weighting in the index. So for example, Nvidia is currently the largest overall company by market cap, so they end up with roughly a 7% weighting in the S&P 500. Apple is a very close second. At the time I made this video, they're also right about 7%. Microsoft's up there, Google, etc., etc. So the bigger a company gets, the bigger the weighting in the index. The Dow Jones 100 does this, except it has a cap. So they're not going to let anything be more than 4% of the index. They also have a cap on sectors. So no single GICS sector, so utilities, tech, whatever, is going to represent more than 25% of the index. They also give their rebalancing rules. They rebalance this portfolio annually. So they would basically trim the winners and distribute that money to the rest of the holdings. So when you're creating your own index, there are really just 3 things that you need. The first thing you need is an investable universe. So when you're deciding what your particular investable universe is, I would recommend starting with what are your goals. So if you're, let's say, someone who's retired or you're maybe wanting to invest and accumulate dividend income, for example, then a dividend index would be a good place for you to start. So you could start with the Dividend 100 that we just looked at, that forms SCHD. That would be one you could use. You could also use the underlying index behind VIG, which is a Dividend Achievers Index. You could also use the dividend aristocrats, which are companies that have raised their dividend for at least 25 consecutive years. Those would all be logical starting points for a dividend investor. Now, if you're someone that wanted a more aggressive, like growth strategy or something like that, you might start with the NASDAQ. The NASDAQ 100 is behind the popular Triple Q ETF, so you could use that as your starting spot. If you're someone that just wants large cap exposure, obviously the S&P 500 is probably the gold standard index for that, at least for US stocks. If you wanted a small cap portfolio, you could start with something like the S&P 600. Or if you're a quality kind of low risk investor, you could use something like there's a US minimum volatility index. There's also a quality index that you could use for this. Basically take your big picture goal, kind of like what kind of investor are you? What are your big goals? And then categorize yourself into some sort of bucket like that, and then pick an index that's most appropriate to kind of align you with your particular goals. For the purposes of the index that I'm going to create, and I will make a video creating an index so you can kind of see exactly how this works, I'm going to use the S&P 500 index. The next step is to come up with the construction. So this is really kind of the meat and potatoes, so to speak, for how you actually pick stocks. What kind of characteristics are you looking for? So the best place to start here, I think, is your overall investment philosophy. So this would be basically like, what do you think drives a good stock investment? What are the characteristics of a good investment? Some people would say, I only want to buy a stock when it's going up, right? So you might be a momentum investor would be your philosophy. Others might be a more deep value philosophy. So you're looking for companies that are trading very cheap prices relative to their intrinsic value. Others may be just looking for high dividend yield. There's a lot of different things that you could use. I'm going to give an illustration of kind of my philosophy, but just know that this is essentially infinite. There's a million ways that you could go about doing this. But my philosophy kind of is in line with many of the legendary investors like Warren Buffett, Charlie Munger, Lou Simpson, etc. And I think the person that best sums this up is Terry Smith. Terry Smith runs Fundsmith, so he's actually an active fund manager, does a great job for his investors. But his philosophy, he says, is number one, buy great companies. Number two, don't pay too much. And then number three, do nothing. So let's explore this philosophy just a bit more. So for me, buying a great company kind of consists of three main things. One is a wide economic moat. Two, I want to see some growth. I don't want to see, shrinking revenues or flat revenues. I want to see some kind of growth. And then finally, I want to have good management. Don't pay too much, meaning I want to have companies that are trading at least at fair value, ideally below fair value, but good values. I'm not expecting to get low PEs. I think that's a misnomer. Value investors think that means buying low PEs. It's not at all what value investing is. Value investing just simply means buying something for less than what it's worth. But finally, after you got your philosophy figured out, now it's time to link different variables that fit this philosophy. Kind of what characteristics define a company with a high moat, growth, etc. And for me, I've already done that. I actually have a score that uses 27 different ratios and financial metrics, and it just ranks them based on how they score compared with the universe and compared with their sector. And then it gets a score out of, I think it's a total of 54 points. So whatever stocks get the highest score, that I think reflects this quality component pretty well. For the management, what I'm going to do is use Glassdoor, and I will show you later on, if you want to watch part 2 of this video, I'll kind of walk you through exactly how I do all of this and find them and kind of build my own index if you want to kind of see how I would do it. But you can use any metric you want for this. Ideally, these are mostly quantitative. That makes it a lot easier for you to manage. It doesn't have to be, but that's makes it real cut and dry. As far as don't pay too much, what I'm going to use for this is my own estimated fair value. Again, I have this on the research platform that I made. I'll talk more about this in the next video, but I'm going to use that as my valuation metric. And then as far as the weighting scheme, I'm going to follow the do nothing principle, which is instead of market cap weighting, instead of equal weighting, instead of fundamental weighting, I'm going to do what I call coffee can weighting. So coffee can weighting is kind of a blend of equal weighting and market cap weighting. So you buy initially at equal weight, and then you let those drift over time. So what's going to happen is we're going to end up, we're going to start with 30 stocks. We're going to equal weight each of those at 3.33% each. And then after, say, 10 years, we're going to end up where most likely something like this. You're going to have a couple stocks, maybe one stock that's up to 15% of the portfolio. So this is the Nvidias, if you will, of the portfolio. They're going to be a huge weighting. Then you're going to have some that really didn't do well at all. They may drop to a 1% weighting, or in extreme cases, we might have one or two go out of business. So they end up at a 0% weighting. Essentially, we're just going to equal weight it at the start and then let the chips fall where they may. The winners are going to keep winning and become an even more bigger part of the portfolio. The losers are going to essentially sell themselves into irrelevance. I've already done the weighting portion. That was the third part of the index equation. You need to determine how you're going to weight the portfolio, which is what I talked about in this section right here. The final part of any index, and the one that's most difficult to apply and most difficult to follow, is consistently applying the methodology over time. The great thing about an index is that once the rules are set, it's really following the rules. So you're consistently managing the portfolio in the exact same way over a very long period of time. That is what's ultimately going to drive success in investing, and it's the one thing that's hardest for most people to do. Very tempting to jump ship, change strategies, do all these, buy QQQ, and then when it starts to underperform, sell it and buy the S&P or whatever it is, flipping, flopping different strategies and different investment philosophies all the time based on what worked last year is a recipe for disaster. So that's the thing that I think indices like the S&P and others do so well. It's not necessarily that they're any kind of magic secret sauce. It's just that they consistently apply it. So I think if you can take whatever your custom index is, whatever rules you create, whatever philosophy you have, and apply it consistently over time, I think you're going to find you do pretty well. Will you beat the S&P or you beat your benchmark? Maybe, maybe not. But even if you don't, I think you'll still find success applying consistent principles for the long term. And the best way to do that is to write it down. If you don't write it down, you're going to forget. You're not going to remember exactly how you did it. So if you want a dollar cost average into this index methodology over time, you need to know what you did, and you need to be able to consistently replicate that. So I wrote this one down, and you can name yours. It's your own custom index. You call it whatever you want. I'm calling this Nathan's S&P 500 Consistent Compounder 30 Coffee Can Index. Now, I probably get a 0 for my naming, definitely for length, but whatever. If you have a better name, you can tell me in the comments down below. But this is my universe, the S&P 500. This is my portfolio construction. So I'm going to use my research platform, coffeecaninvesting.app, and I'm going to use just the 5-star quality scores. It ends up being about, I think, 50 to 75 stocks. I don't remember exactly how many I had on the list, but I'm going to use that. And then I'm going to rank them best to worst on estimated fair value, again, using the formula on my research platform. Then I'm going to exclude the stocks where Glassdoor's CEO approval rating is less than 68%. I'll talk more about that in the next video. I'm also going to exclude stocks where the estimated fair value is inconsistent or trending down over the long term. This is where things get a little bit more subjective. Again, I'll talk more about that in the next video. My weighting scheme, like I said, I'm going to do the coffee can weighting scheme. I'm going to do 30 stocks at 3.3% each to start. And then I'm also going to apply a limit, a sub-industry limit, no more than 10% at the initial buy. So if you're interested in seeing how I build my index and what stocks make it in there, you should check out the next video in the series. I will be posting this tomorrow. So if you're watching this on Black Friday 2025, the next video will come out tomorrow. So Saturday, the 29th of November. If you're watching this after the fact, the video will be posted already and you can probably find it up here somewhere, so click on that if you want to see that. In the series, I will be using my new research platform, coffeecaninvesting.app. If you're interested in checking that out, I'll put a link in the description down below. Thanks for watching, and I hope to see you in the next video.